Hi, good evening one and all. Today I am going to start Advanced Financial Management, which is paper 2 in CA Final. Particularly in this video I am going to discuss chapter 2, that is Risk Management. This chapter consists of two questions. One is example and the other one is test your knowledge question. I will be discussing these two questions in a very depth manner. But still, if you have any doubt, please let me know in the comment section. I'll try to solve your queries. Now, without wasting much time, let us quickly jump into our topic of discussion. Before discussing questions, I would like to discuss some important points from this chapter. So the first important point is VAR. VAR stands for Value at Risk. How to calculate value at risk? So there is one formula. VAR is equal to standard deviation into Z score. You have to remember one thing. At 99% confidence, Z score is 2.33. Please try to remember this. Now we will try to solve example. So the example is, the concept of VAR can be understood in a better manner with the help of following example. Suppose you hold worth rupees 2 crore shares of X Ltd, whose market price standard deviation is 2% per day. Assuming 252 trading days a year, determine maximum possible loss over the period of 1 trading day and 10 trading day with 99% confidence level. So in this example, they are asking us to determine maximum possible loss. So we are expected to find maximum possible loss over the period of 1 trading day as well as 10 trading days. So here we understood we are expected to find maximum possible loss for 1 day as well as for 10 days. Now there are few steps to calculate maximum possible loss. So the first step is volatility in terms of rupees. Volatility in the sense changes. Now see here, we are holding 2 crore shares and the standard deviation is 2% per day. It means volatility is 2 crores into 2%, which is 4 lakhs. Now step 2 is, we will be calculating maximum possible loss. We are expected to find maximum possible loss for 1 day as well as for 10 days. So first I will be calculating maximum possible loss for 1 day. So it will be 4 lakhs into under root of 1. Since we are calculating for 1 day, I am writing under root of 1. If I am calculating for 2 days, I will be writing under root of 2. Similarly, when I calculate for 10 days, I will be writing under root of 10. So 4 lakh into under root of 1 is 4 lakh. Here in the question, they are asking us to find maximum possible loss for 1 day at 99% confidence level. As I already mentioned, at 99% confidence level, Z score is 2.33. So maximum possible loss for 1 day at 99% confidence will be you just have to combine this as well as this. We already got maximum possible loss for one day as 4 lakh. We already know at 99% confidence Z score is 2.33. So 4 lakh into 2.33 will be 9,32,000. Now the last step, that is step 3, we are expected to find maximum possible loss for 10 days. As I have already mentioned, if they are asking for one day, we will be writing under root of 1. Similarly, for 10 days, we will be writing under root of 10. Since we have already got maximum possible loss for one day, that is 9,32,000, I will be writing here 9,32,000 into under root of 10. Again, I will not write 2.33 because this 9,32,000 is inclusive of Z score. So 9,32,000 into under root of 10 will be 29,47,000. Please go through with the solution once. Now proceeding further, consider a portfolio consisting of 2 crore investment in share XYZ and 2 crore investment in share ABC. The daily standard deviation of both shares is 1% and coefficient of correlation between them is 0.3. You are required to determine the 10-day 99% value at risk for the portfolio. In this question, we are expected to find value at risk. What is the formula of value at risk? Standard deviation into Z score. Here they are asking us to find at 99% confidence. I already asked you to remember, at 99% confidence Z score is 2.33. So we know Z score as 2.33. We have to find standard deviation. You might be getting doubt. Standard deviation is already given in question as 1%. No, actually this standard deviation is standard deviation of shares, but we want standard deviation of portfolio. Now we will be solving the question. The daily standard deviation of both shares is 1% and coefficient of correlation between them is 0.3. I will be quickly noting down whatever information is given in question. See, coefficient of correlation is denoted by alphabet small r. So it is given in question as 0.3 and daily changes in daily standard deviation of both shares is 1%. So here I am writing standard deviation of both shares, or else you can say assets, is 1%. 1% of 2 crores. That is nothing but 2 lakhs. So here I can say standard deviation of XYZ is equal to 2 lakhs. Standard deviation of ABC is equal to 2 lakhs. For convenience purpose, I am assuming standard deviation of XYZ as small a, standard deviation of ABC as small b. Now coming back to formula, here we are expected to find value at risk. The formula is standard deviation into Z score. We already know Z score is at 99% confidence. The value is 2.33. Now we are expected to find standard deviation. We can't find standard deviation directly. So first we will be finding out variance. Variance. There is one formula to remember variance. A square plus B square plus 2AB into R. Now we just have to substitute values in this particular formula. A is nothing but 2 lakhs. So 2 lakhs whole square plus B is nothing but 2 lakhs. So 2 lakhs whole square plus 2. A again 2 lakhs. B 2 lakhs. R coefficient of correlation, that is 0.3. 2 lakh whole square 4 lakh square. 2 lakh whole square is 4 lakh square plus 2 2's 4, 4 2's 8, 8 into 0.3 is 2.4 lakh square. Now when you add this, you will be getting 10.4 lakh square. But we don't need variance, we need standard deviation. How we can get standard deviation? Standard deviation is nothing but under root of variance. So under root of 10.4 lakh square. 10.4 lakh can be written as 10.4 under root can be written as 3.22 lakh whole square under root. Square root gets cancelled, so the standard deviation is 3.22 lakhs. This standard deviation is standard deviation for 1 day, because as already told you, standard deviation for 1 day is equal to 3.22 lakhs into under root of 1. So you will be getting the same value, that is 3.22 lakhs. But when you see the question, we are expected to find for 10 days. So as already mentioned, when you have to calculate standard deviation for 10 days, you will be writing under root of 10. So here 3.22 lakhs into under root of 10. So 10 under root into 3.22. So it will be 10.18. So 10,18,000. Now we got standard deviation as well as we got Z score. Now we will just substitute in this particular formula. So value at risk is equal to standard deviation for 10 days, that is 10,18,000 into Z score, that is 2.33. So 10,18,000 into 2.33 is 2.33, 23,72,000. So this is our VAR. Please go through with the solution once. I am concluding my session here, and if you like today's video, please do like, share and subscribe to my channel, and you can give suggestions in the comment section. Thank you.